You hesitate with your order ticket open, then add a little more size because the setup still looks convincing. A few minutes later, price moves against you, and instead of accepting the original risk, you widen the stop just enough to give the trade room. The position has not changed. Only your willingness to recognize the mistake has. That decision rarely begins with the chart. It begins with a quiet refusal to let one small loss become real. The market does not reward that hesitation. It simply continues to price new information while your risk quietly grows beyond what you first accepted. Imagine a hypothetical breakout above a well-defined resistance level. The candle closes strong, you enter immediately, and the next bar slips back beneath the breakout. That single move creates a choice as exit, because the original idea may no longer be valid, or stay because leaving now feels worse than hoping. The outcome is uncertain either way, but the consequences of each decision are very different. The same conflict appears outside the chart. Every dollar you keep in cash feels safe. Every dollar you commit to a trade feels exposed. Yet placing money into either choice without understanding the risk behind it can become equally expensive for different reasons. Before comparing saving with investing, one simple decision has to be examined first: what your next dollar is actually trying to protect, and why that answer quietly changes every decision on the chart that follows. The question is not whether your next dollar should be saved or invested. That question comes too late. The real decision is made the moment you decide what that dollar is supposed to do. Without a defined purpose, every financial choice becomes vulnerable to emotion. A dollar with no assignment is easily redirected by headlines, price movements, or the feeling that you might be missing an opportunity. The market exposes this mistake every day. A trader deposits fresh capital after seeing a strong rally, not because the original plan changed, but because excitement quietly replaced purpose. The money was never intended for market risk until the market itself became persuasive. That subtle shift matters. When the reason for committing capital changes after the opportunity appears, the decision is already being led by the environment instead of by discipline. Think about two identical $100 bills. They have the same value, but they do not necessarily have the same job. One may exist to remain available regardless of market conditions. The other may exist specifically to accept uncertainty in exchange for the possibility of future growth. The bills are identical. Their functions are not. Confusing those functions creates conflict long before a trade is entered. That confusion often reveals itself at the worst possible moment. Suppose a position begins to move against you. If the money in that trade was never mentally separated from the money meant to provide stability, every small decline feels larger than it actually is. The market has not changed. Your relationship with the capital has. You are no longer evaluating the trade. You are protecting money that was never meant to be exposed in the first place. The opposite mistake is just as costly. Some people treat every dollar as if it must remain protected forever. Over time, cash reserved for immediate security quietly expands into cash reserved for every possible uncertainty. Nothing forces that decision. It simply becomes the default because leaving money untouched always feels easier than accepting visible risk. The purpose of the capital slowly disappears, replaced by habit. Discipline begins before any chart is opened. It begins by giving each dollar a single responsibility and refusing to change that responsibility because today's market looks attractive or frightening. Once a dollar has been assigned its role, the market is no longer deciding for you. It is only testing whether you will remain consistent with the decision you already made. That raises another question. Even if every dollar has a clearly defined purpose, what happens when waiting feels perfectly safe? The answer is less obvious than it first appears, because standing still has a cost that rarely announces itself while it is happening. Doing nothing rarely feels expensive. That is why it is so persuasive. When money stays exactly where it is, there is no visible loss, no uncomfortable price movement, and no difficult decision after the fact. The absence of action creates the impression that nothing has changed. But the absence of visible change is not the same as the absence of cost. Think about what happens over the course of a year. Markets move through advances, declines, recoveries, and periods where quality opportunities briefly appear before disappearing again. If your capital never participates because every decision is postponed until conditions feel completely certain, time continues to move even while your money does not. The cost is measured not by what you lost, but by what your capital never had the chance to become. This is why waiting deserves the same level of examination as acting. A trade can be evaluated because it leaves a record. An opportunity that was never taken leaves almost nothing behind. There is no entry price to review, no exit to analyze, and no account statement showing the value of disciplined inaction versus unnecessary delay. The opportunity simply disappears, making its cost easy to ignore. Imagine a hypothetical situation. An investor spends months researching a business, determines that the risks appear reasonable, then decides to wait just a little longer for perfect clarity. During that time, nothing fundamentally changes in the analysis, yet the decision is postponed again because uncertainty still exists. Eventually, the price adjusts to reflect the improving outlook. The missed return did not result from a bad investment. It resulted from demanding a level of certainty that markets never provide. That does not mean every missed opportunity is a mistake. Passing on poor opportunities is one of the most valuable decisions anyone can make. The difficult part is recognizing the difference between disciplined patience and endless postponement. From the outside, both look identical. In both cases, no money is invested. The difference exists only in the quality of the reasoning behind the decision. A useful question is not, am I waiting? The better question is, what new information am I actually waiting for? If you cannot answer that clearly, delay may no longer be serving a purpose. Time has quietly become a substitute for making a decision. Waiting without a defined condition often becomes permanent, because there is no event capable of ending it. The market has an uncomfortable habit of moving before certainty arrives. By the time uncertainty disappears, prices often reflect information that was once available only to those willing to act without complete assurance. That does not make early action automatically correct. It simply reminds you that certainty and opportunity rarely reach the same place at the same time. The next question is not whether waiting has a cost. It is whether your financial position can afford the uncertainty that comes with acting before every answer is available. People often measure risk by asking a simple question: how much could I lose? It sounds sensible, but it leaves out something more important. The better question is, can my financial life continue normally if that loss actually happens? Those are not the same question. One measures a number. The other measures resilience. Imagine two people making the exact same investment with the exact same amount of money. The market falls 20%. One barely notices because nothing essential changes outside the investment account. The other suddenly delays important expenses, worries about monthly obligations, and feels pressure to recover quickly. The market delivered the same result to both. Their financial position transformed that result into two completely different experiences. This is why risk capacity exists independently of confidence. You can feel certain about an opportunity and still lack the ability to absorb a disappointing outcome. Confidence is an opinion about the future. Capacity is a fact about the present. Markets respond only to the second when events fail to unfold as expected. Notice what happens when those two ideas become confused. A person who cannot comfortably absorb a temporary decline begins demanding immediate proof that the decision was correct. Every normal fluctuation starts to feel like an emergency because the money now carries responsibilities beyond the investment itself. The market has not become more dangerous. The financial consequences of being wrong have simply become too large. That changes the quality of every decision that follows. Instead of evaluating new information objectively, attention shifts toward escaping discomfort. Patience becomes difficult because time itself now increases anxiety. Small setbacks appear larger than they are because they threaten something outside the investment. When capital is carrying obligations it was never able to support, even ordinary uncertainty feels excessive. This does not suggest that investing should wait until all financial pressure disappears. Complete certainty about personal finances rarely exists. The point is much narrower. Your exposure to uncertainty should remain small enough that a disappointing outcome does not force unrelated decisions. If an investment begins dictating choices about necessities, then the position has grown beyond your capacity, regardless of how attractive the opportunity once appeared. A practical way to think about this is to imagine that tomorrow brings an unfavorable surprise. Not a disaster, just an outcome that proves your expectation was wrong. Would your response involve adjusting the investment, or would it require adjusting your everyday life? That distinction reveals far more than optimism ever can. Once your financial position can absorb uncertainty without disrupting everything around it, another question naturally appears. Even with sufficient resilience, should every dollar face the same amount of time before you expect it to work for you? That answer depends on something entirely different from risk alone. People often ask whether an investment is good or bad without asking a simpler question first: when will this money be needed again? The quality of an investment cannot be separated from the amount of time you allow it to work. The same opportunity can be perfectly reasonable over several years and completely unsuitable over several months. Markets move in cycles, not in straight lines. Even strong long-term trends experience periods of uncertainty, sharp pullbacks, and stretches where progress appears to disappear. If your deadline arrives during one of those periods, the investment may have no opportunity to recover before the money is required. The problem is not always the investment itself. The problem is the calendar attached to it. Imagine two investors buying the same asset on the same day at the same price. One plans to use the money 6 months later for a home purchase. The other has no intention of touching it for 10 years. A temporary decline creates completely different pressures. The first investor may be forced to sell because time has run out. The second can continue evaluating the investment without an immediate deadline influencing every decision. Identical assets, identical prices, different clocks, different outcomes. That is why time changes the meaning of risk. A short time horizon reduces your ability to wait through ordinary market fluctuations. A longer horizon increases the possibility that temporary setbacks become just one small part of a much larger movement. Time does not eliminate uncertainty, but it changes how much uncertainty you can reasonably tolerate before action becomes necessary. This is also why impatience quietly distorts financial decisions. When someone expects long-term results within a short period, normal market behavior begins to look like failure. Every month without visible progress feels disappointing because expectations were placed on a schedule the investment was never designed to meet. The investment is judged against the wrong clock instead of its intended purpose. Before committing money, try asking a different question. If the market moves against this position tomorrow and remains weak for several months, will I still be able to leave this capital untouched until its original purpose arrives? That question shifts attention away from predicting prices and toward matching time with responsibility. Notice that this has nothing to do with optimism. Even an excellent opportunity cannot guarantee favorable timing. Markets are uncertain by nature. What you can control is whether your financial deadline gives that uncertainty enough room to unfold without forcing an unnecessary decision. Time should support your plan, not compete with it. When the purpose of the money is clear, your ability to absorb risk is realistic, and the time horizon matches the decision, one final obstacle remains. It is often invisible, yet it influences choices more than charts, forecasts, or deadlines ever do, the way your own mind weighs a possible loss against a missed opportunity. There is an interesting imbalance in the way the mind evaluates outcomes. Losing $100 usually feels more immediate than missing the chance to earn $100. One creates a visible wound. The other leaves no obvious mark. As a result, decisions often favor avoiding pain today over improving tomorrow. That instinct is understandable. A realized loss demands attention because it can be measured immediately. A missed opportunity is much harder to notice. You cannot open an account statement and see every investment you chose not to make. Those outcomes exist only as possibilities, so they rarely produce the same emotional response. The mind naturally gives more weight to what it can clearly see. This creates a quiet distortion in financial decisions. Imagine two choices that carry different forms of uncertainty. One offers the possibility of temporary loss along with the potential for future growth. The other preserves today's balance, but leaves tomorrow unchanged. If your attention focuses only on protecting the present, the second option will almost always feel more comfortable, even when the long-term trade off deserves equal consideration. Notice how this process unfolds. You are not necessarily choosing the better decision. You are choosing the decision that removes the strongest immediate discomfort. The emotional relief arrives first, while the economic consequences reveal themselves slowly. Because those consequences are delayed, they are easy to underestimate when the decision is made. This does not mean that taking risk is automatically wiser than avoiding it. Markets remain uncertain, and preserving capital is sometimes the correct choice. The important distinction is understanding why you made the decision. Did you evaluate both possibilities with the same care, or did one simply feel less uncomfortable? Those are very different decision-making processes, even if they produce the same action. A useful exercise is to examine both sides of every choice with equal seriousness. If you decide to keep your money out of the market, ask yourself what you might reasonably give up by doing so. If you decide to invest, ask what temporary setbacks you are genuinely prepared to accept. By forcing both outcomes into view, the decision becomes more balanced because neither side remains invisible. Over time, this habit changes how you think about uncertainty. Instead of viewing only the cost of acting, you also recognize the cost of never acting. Instead of protecting yourself from one type of mistake while ignoring another, you begin comparing two imperfect alternatives with greater clarity. That shift does not eliminate uncertainty, but it makes your reasoning more complete. Even then, understanding your own biases is not enough. A sound decision still requires a process that remains consistent when markets become exciting, frightening, or distracting. Without that process, today's emotions can quietly replace yesterday's careful thinking. A surprising number of financial decisions are made after the market has already influenced them. A rally creates urgency. A sharp decline creates hesitation. A dramatic headline creates confidence or fear. By the time money is committed, the decision often reflects the latest event rather than the original objective. The market did not simply provide information. It quietly rewrote the decision-making process. This happens because the human mind adapts quickly to whatever is happening now. Recent price movement feels more important than it actually is because it is fresh, visible, and emotionally charged. A calm plan created last month suddenly competes with today's excitement. Without realizing it, you begin comparing your long-term intentions against short-term emotions. Short-term emotions usually speak louder. The problem is not that new information should be ignored. Sometimes events genuinely change the situation and deserve a different response. The difficulty is distinguishing between information that changes the facts and information that merely changes your feelings. Those two forces often arrive together, but they should never be treated as the same thing. Imagine that you decided months ago to invest a fixed amount whenever additional capital became available. Then the market rises sharply over several weeks. Instead of following the original decision, you suddenly feel that prices have moved too far. A month later the market falls, and now you feel that conditions are too uncertain. In both cases, the decision changes even though your financial objective remains exactly the same. The market is now determining your behavior instead of your reasoning. A stronger process begins before those moments arrive. It separates the question of, "What am I trying to accomplish?" from the question of, "What is the market doing today?" Once the first answer is established, the second can be evaluated without constantly changing direction. The process does not predict outcomes. It protects consistency. That consistency has another benefit. It reduces the number of decisions you must make while emotions are strongest. Every unnecessary decision becomes another opportunity for impulse to replace judgment. A well-defined process removes many of those moments because important choices have already been made under calmer conditions. Notice what this approach does not promise. It does not guarantee better returns or eliminate mistakes. Markets remain uncertain regardless of preparation. What it changes is the quality of your reasoning. Instead of reacting to every new movement, you compare new information against an existing framework. If the facts truly require a different decision, you adjust deliberately. If they do not, you avoid changing course simply because the market has become louder. Once a consistent decision process is in place, another question naturally follows. Even disciplined reasoning exists within changing market conditions, and those conditions can alter the level of uncertainty without changing your underlying objective. Market conditions are always changing, but your financial purpose usually is not. Prices become more volatile, headlines become more dramatic, optimism turns into caution, and caution eventually becomes confidence again. These shifts are real, and they deserve attention. The mistake begins when changing conditions are allowed to redefine a decision that was built on a stable objective. Consider how easily the environment influences perception. During a strong rally, risk often appears smaller than it truly is because recent price movement encourages confidence. During a sharp decline, the same assets may suddenly seem unacceptable because uncertainty has become more visible. Yet the underlying purpose of your capital may not have changed at all. Only the atmosphere surrounding the decision has. This does not mean market conditions should be ignored. Different environments genuinely present different levels of uncertainty. A calm, steadily trending market does not create the same challenges as one driven by rapid reversals and unexpected news. Pretending those differences do not exist is no more disciplined than reacting emotionally to every price swing. The important distinction is knowing what market conditions are allowed to change. They may influence how cautiously you evaluate new opportunities or how much uncertainty you recognize before acting. They should not automatically change the reason you are investing in the first place. When the market begins rewriting your objective, instead of informing your judgment, the environment has gained more control than it deserves. Imagine a hypothetical investor who adds money consistently over time. After a period of strong gains, they feel compelled to invest more simply because prices continue rising. Months later, after a significant decline, they stop investing entirely because conditions suddenly feel dangerous. In both cases, the decision follows recent market behavior instead of a stable plan. The allocation changes, not because their financial needs changed, but because the emotional tone of the market changed first. A disciplined approach recognizes that uncertainty expands and contracts without requiring a complete change in direction every time it does. Markets breathe. They move between optimism and pessimism, activity and hesitation. If every change in mood produces a new financial plan, consistency disappears long before results have time to develop. One useful habit is to separate observation from reaction. Observe that volatility has increased. Observe that optimism has become widespread. Observe that uncertainty is elevated. Then ask a different question. Does this information require a meaningful change to my reasoning, or is it simply describing the current environment? That short pause often prevents temporary conditions from becoming permanent decisions. When your objective remains steady while your awareness adapts to changing conditions, the market becomes something to interpret rather than something to obey. It continues to influence probabilities, but it no longer dictates your purpose. Even with a stable objective and a disciplined response to changing environments, the outcome of your financial life will still depend on something quieter, not one impressive decision, but the direction your next dollar takes again and again over many years. People often remember the financial decisions that changed everything. A profitable investment, a costly mistake, or the moment they finally entered the market. Those moments feel important because they are easy to recall. What usually goes unnoticed are the hundreds of ordinary decisions that quietly made those defining moments possible. Financial outcomes rarely depend on one dramatic choice. They are shaped by repetition. Every time new money becomes available, you make another allocation decision. It may seem too small to matter, but small decisions repeated consistently begin to establish a direction. Direction, maintained over years, often has a greater influence than occasional brilliance. Imagine someone who receives additional income every month. Instead of making one large decision about their future, they repeatedly answer the same simple question. Where should this next dollar go? Each answer appears insignificant on its own. Yet after dozens or hundreds of repetitions, a clear pattern emerges. The habit becomes stronger than any individual decision because it quietly defines what happens next without requiring constant debate. This is why habits deserve as much attention as intentions. Good intentions exist comfortably in the future. Habits operate in the present. You may intend to invest regularly, preserve appropriate reserves, or follow a thoughtful plan. But when new money actually arrives, habit determines whether those intentions become action or remain ideas waiting for a better time. Notice how repetition changes the nature of the decision. The first investment may feel difficult because it carries uncertainty. The 10th requires less emotional energy because it follows an established pattern. Eventually, consistency begins reducing unnecessary decision-making. Instead of starting from the beginning each time, you continue a process that already exists. The reverse is equally true. Delaying one decision rarely creates lasting damage by itself. Delaying repeatedly creates a habit of postponement. Choosing convenience once is ordinary. Choosing it every time gradually becomes your default response. Without intending to, you begin building a financial identity based not on careful planning, but on repeated hesitation. This is one reason disciplined people often appear more consistent than exceptional. They are not constantly searching for the perfect decision. They are protecting a pattern that keeps producing reasonable decisions. Their attention shifts from isolated outcomes to the quality of repetition itself. Individual results remain uncertain, but the process grows more dependable with every cycle. A useful question, then, is not whether today's decision is large enough to matter. Ask instead whether you would be comfortable repeating this exact decision every time new capital becomes available. If the answer is no, the issue may not be today's dollar. It may be the habit you are quietly creating. Even the strongest habit, however, cannot solve every financial problem. There are moments when the availability of cash becomes more valuable than the return an investment might eventually produce, and understanding that distinction requires looking beyond repetition alone.